For the last few weeks, with the markets having rallied almost exactly 8 months off the October 2022 lows, we've discussed our view that with FOMO, that's the fear of missing out, setting in June, it was our team's view that it was finally time for the markets to top out for the summer. 2 weeks ago, our video title was S&P 500, It's Summer, Time for a Rest. And last week, it was on the topic of FOMO and the wrong way to invest. Investors, it's summer. The markets have rallied for exactly 8 months off the early fourth quarter 2022 lows. It's time for the markets to rest and pull back. Nothing disastrous, but then again, not an enjoyable time to come if you're watching your statements daily, making your net worth mark to market every day, which is a bad habit and will only lead to poor investment returns and anxiety. This week's content, July 4th weekend, where we stand, is just some additional detail into our thoughts from here for the next few months. Before we get into this week's content, please take a moment to click on both the subscribe and the notification bells so you'll be alerted when our investment team uploads our latest content. Or better yet, call our Oak Harvest team at 877-896-0040 to speak to our team and set up a free initial consultation with an Oak Harvest advisor to discuss your personal financial situation. Frequent viewers and listeners of our content know that our team was quite bullish on the first half of 2023 heading into the year, despite the ongoing, almost non-stop negative rhetoric on TV and in the financial press. Our first half outlook for 2023 was penned in December 2022. It was titled The Old Normal, had a S&P forecast of 4,300 on the cash S&P when the markets were trading around 3,800. Think way back to the fourth quarter of 2022. Here's a monthly chart on the S&P 500 to visually jog your memory of where we were and how far we've come the last 8 months. Recall back in October, that's the last circle and arrow on the chart. Almost all the news was negative on inflation, the economy, and the news channels. The prevailing story circulated by many retired billionaire hedge fund managers, many one-hit wonder portfolio managers, many economists and newsletter writers was a crash like the dot-com bubble or great financial crisis was coming. It was right around the corner. Some predicted it was to start almost to the week and day of the market's lows last year. Here's the weekly chart of the S&P 500. The dark highlighted circle was the same October low last year. For over 6 months, we heard from many strategists and chartists on TV that we would retest those October lows shortly or even make new lows, and that the markets were overvalued. Well, folks, that didn't happen. And if you were listening to them, you're either still waiting for the all clear, or you're now hearing them turn more bullish up 800 points in 8 months because their charts have now turned a prettier picture. Here's that prettier picture of the daily chart of the S&P 500 now that they are referencing. They now reference the very obvious higher lows and higher highs we made since we cleared the resistance area of around 4,200. Even retired billionaire hedge fund managers like Ray Dalio seem to have thrown in the towel and now deem it okay to buy stocks. This is the same legendary investor who on October 3rd of last year deemed cash is not trash within a week of the stock market 2022 lows when you should have been buying stocks. On June 12th, so far, only 2 days in front of the market's short-term top declared, it's time to buy stocks. Investors, please tune out this news when it's presented as such on TV or in the financial newsletters. Retired billionaire hedge fund managers know nothing of your personal financial situation or your financial plan. So the big question on everyone's mind is, now what? First, it's summer. Historically, our economy slows in summer as consumers and businesses take a break from their normal activities. The economic data is showing this currently on lower than expected PMIs, that's purchasing manager intentions. With this economic slowdown usually comes a stock market downturn, particularly when central banks are upping their interest rate increases rhetoric. With the markets up on a spike and volatility having crashed as we expected, expect traders to sell and investors who bought near the June 2022 lows to trim some winners and lock in long-term capital gains. Investors, please try not to be swayed by the likes of Ray Dalio or sell-side strategists, many who have now lifted their year-end 2023 S&P 500 targets by 300 to 500 points given the markets moved higher. Relax. The market should pull back and digest its year-to-date gains over the next 2 to 4 months. It's summertime, and it's time for the markets to rest. It should be a very normal -4 to -5% move down over the next few months, followed by another few months of bouncing around. Call this move -200 to -250 points down in the S&P 500. This would take the markets back to where it was just last April, where the S&P 500 was 4,200 to 4,175. This level has also happened to be where the Powell puke in August of 2022 happened. You can see all these levels on the charts earlier in my video. The cost of insuring your portfolio has collapsed as we expected. Here's that chart of the forward volatility futures. We're at the bottom of the downward channel. If I was back running a hedge fund, I would be hedged up, long lots of cash, doing research for the next few months while I sorted through names and ideas that I wanted to buy late in the summer or early in the fall of the fourth quarter of this year and the first half of 2024. Investors, while we are expecting a few months of down and back and forth, we aren't expecting a disaster as many have preached for the last 12 to 18 months. Per Merrill Lynch, statistically speaking, the S&P 500 entered its 27th bull market of 20% or more on June 8. If you missed the 8-month rally, should you panic right now and buy stocks, getting 100% invested? No. Should you make big bullish changes to your investment allocation? No. However, yes, the data is promising for the next 12 months. The year after the S&P 500 enters a cyclical bull market shows the index higher 65% of the time, with the average return of 9.4% and a median return of 14.1%. Those returns would equate to 4,700 on the S&P 500 and maybe even 4,900 into June of 2024. Investors, for what it's worth, my model has the S&P 500 returning to the level of 4,700 later this year after a summer stall and a summer sell-off. As for 2024, I don't know yet. I can come up with even much higher bullish outcomes than 4,900, as well as wildly lower bearish outcomes. Let's see what the rest of 2023 holds first. So for those of you who've made it through this video, that's a sneak peek of what our team thinks might be in store for the rest of 2023. For now, we are thinking down back to 4,200 or slightly lower over the next 2 months into mid-August, then bouncing around into late third quarter, and then a strong year-end rally back towards just short of all-time highs for the S&P 500. While summer is a normal time for investors to get away from their screens and focus their attention on family and fun, I would suggest you take the recent run-up in the markets and crash and volatility to get on the phone and give us a call at Oak Harvest. Set up an initial consultation with an Oak Harvest advisor, and if you're an existing client, schedule a review of your financial plan, your goals and objectives, and your asset allocation. Now is the time to review your goals and objectives, not when things are whipping back and forth, up and down quickly in the markets. If you're having the thoughts, I need more growth in my portfolio or I need more income, making those asset allocation actions are best done when the markets are calm. But investors, remember, there are no guarantees in the markets. You can't just turn on more growth or turn on more income in the stock markets. That's not the way they work. The exact path forward is always uncertain, and making asset allocation decisions in your portfolio, be it stock or bond mix or equity style changes, are best made when markets are calm and emotions are running low. Making emotional decisions when markets are volatile and we're feeling highs and lows as an investor is the wrong way to invest in my book. At Oak Harvest, we have many tools that our advisors use to help our clients meet their retirement goals and objectives. These tools are both market-based and insurance-based, and we can use them both to meet your retirement goals. The future and the stock markets are always uncertain. That's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. From the whole team here at Oak Harvest, have a blessed weekend.